What is going on, everybody? Welcome back to another YouTube video. Now, in today's YouTube video, we'll be going through a trade that I took on the 24th of February 2026, and I'll be pretty much sharing with you guys my exact entry points, where I put my stop loss and where I decided to take my profits and the reasoning behind these. So without further ado, let's get right into the trade. Alright, so as you guys all know, that the first thing I always look for before even looking for a trade is a sweep of liquidity. I must see a buy side liquidity level getting swept or a sell side liquidity level getting swept. And we could determine these buy side and sell side liquidity levels by actually marking up the previous session highs and lows. So as you can see right here to the left of us, we actually do have London highs that were created in the London session. So if you look very closely, we have a vertical line from 2 a.m. all the way to 8:30, which is New York pre-market open. That period right here is considered to be the London session. So we still have that London session still intact till 8:30. And as we could see, we come up and we actually sweep that buy side liquidity level, also the London highs, at 9:44 a.m. Now, after sweeping that buy side liquidity level, we are going to now be looking for a swing low to be created. And the reason why I want to see a swing low being created is because step number 3 and step number 4 are both correlated to that swing low being created. Without that step number 2, then step number 3 and step number 4 are pretty much unavailable to be shown on the charts, right? So I also want to be looking at ES&P as well. I need to be seeing the swing low being created on ES&P just because we need to have correlating assets. What I mean by correlating assets is that whatever happens on NQ must happen on ES as well to have a high probability of a trade. I don't want to see NQ creating a swing low, but ES not creating a swing low. I need to see both of them giving me the same price action in order, again, to have that high probability of a trade. Now, if you look very closely, we do get this swing low at 953 on NQ, and we get this swing low at 951 on ES&P 500. Now, the swing low doesn't have to be the exact same swing low. It could be a minute or two before or after, but as long as we have a swing low in that vicinity, then we should be fine. Now, hopping into step number 3 and step number 4, which is the market structure shift and displacement. These two pretty much come into the same candle and happen at pretty much the same time. So market structure shift is pretty much, you see this candle right here at 955. This candle breaks and closes below this swing low that was created at 953. That is essentially just called a market structure shift, right? And within that market structure shift is a displacement. And a displacement is pretty much just a big impulsive move to the downside in this scenario. Now, again, if we look to the right-hand side, we get this swing low at 951. Keep an eye out on that because this candle at 953 came opened and closed below this swing low at 951. Again, that is just a market structure shift and a displacement. As we can see, it's a big, strong push to the downside. So coming into step number 5 on our trade criteria here is we need to be seeing a fair value gap being created, especially on NQ, since that is the asset we're going to be trading on. Now, not every time we need to be seeing a fair value gap on ES because we're not going to be executing off ES, but we do need to see a fair value gap get created on NQ. So as we can see right here, we do get this fair value gap that was created at 955. And keep in mind, most of the time, not always, but most of the time, when the displacement occurs and the market structure shift occurs, usually that provides us with that fair value gap. But sometimes it doesn't, and it's still fine. It's still a valid trade. So we mark up this fair value gap. We draw that out in time. And if we do want to see the fair value gap on ES as well, we also get this fair value gap at 955 also. So this fair value gap is going to be very important because this is when we actually execute the trade. As soon as price retraces into and touches the edge of that fair value gap, that's when we're going to execute the trade going short. So step number 6 on our trade criteria, just as I mentioned, as soon as price retraces, and what I mean by retraces is pretty much when price comes and taps back into that fair value gap, as we can see right here at 957, price comes and taps into that fair value gap. That's exactly when we're going to be executing short. Now, for our stop loss, we always want to be placing our stop loss above the nearest swing high to the left of us, which, as we can see right here, it's going to be this 952 swing high. But in this scenario, our risk reward is only going to be a 1-to-1. So you want to usually put your stop loss above the displacement candles high. Again, that is still a valid stop loss placement. Now, for our take profit, now this is where a lot of people actually get kind of greedy, and this is where they end up being getting a break even on a day or a loss even. So thinking about it, I always say you always want to be targeting your opposing liquidity. Well, as soon as I say that, you're always going to be thinking about, all right, then opposing liquidity is going to be that sell side liquidity, that swing low. That is absolutely correct. But if you look very closely, the first actual lowest hanging fruit on this trade is going to be the 50% of this range. And as I mentioned in a few of my videos before, that if we see price rallying up pretty smoothly to the upside or going down pretty smoothly to the downside, we want to be measuring out that 50% of the range. Usually price literally taps and reverses, as you can see right here in this scenario. So in this case, the lowest hanging fruit would be that 50% of the range. Now, if you also hop into the 5-minute time frame, we can see that there is a 5-minute fair value gap that is bullish, that price might want to be retracing into and then pulling up also. So you're going to be careful with all the other time frames as well. You don't want to be only looking at the 1 minute and also the 15-minute, but rather you also want to be looking at the 5, the 1 hour, 4 hour, obviously the daily, to determine your daily buys and so on and so forth. Now, you could leave a runner obviously down to this sell side liquidity level, that minus sell side liquidity level. Definitely you could for around about 192 handle win, but you want to be taking around 90% of your trade obviously outside of the markets as soon as it hits that 50% of the range. Now, another thing that I want to mention to you guys is that if you look onto the right hand side on S&P 500, you see that we actually hit 50% of the range around the middle of this 10 a.m. candle. So what I did actually is I took 50% off my trade as soon as price hit 50% on S&P 500. 50% of the trade was off as soon as ES hit the objective first. Now, a lot of the time, price might hit the objective on ES and actually miss the objective on NQ, and you think that the objective is still not been hit. But we always got to remember that both NQ and ES are correlating assets, and if one asset hits the objective prior to the other one, so in this scenario, ES hits the 50% range before NQ, then you should take around 50% of your total position off, just in case price doesn't actually hit the 50% on NQ. And that way you secure some profits and you go home on a green day. And there you have it, guys. Literally, TP hit within 1, 2, 3, 4 minutes, and you bagged around 57 handles, which is absolutely insane in the markets. Now, something that I do also want to mention to you guys is the macro time. It's very, very important to execute your trades between 9:45 a.m. and 10:15, as that is the first AM macro. Now, our second AM macro starts from 10:45 all the way to 11:15. It's very important to only execute your trades within those 2 30-minute intervals and not outside of them, because that is when price usually tends to seek the key levels, as you can see right here in the first AM macro, seek that 50% of the range and kept on going up higher and higher. Now, lately, the market has not been giving us a lot of opportunities, but you always got to stay patient, guys. Try to stay as patient as you can. Try to always follow your rules. Don't be going outside of your way and not following your rules, thinking you win that way. Trust me, guys, just keep on following your rules every single day. If there's no opportunity, then there's no opportunity, because at the end of the day, following your rules is what leads you to that profitability. So make sure to always, always, always follow your rules and do not break them, even if there's no trades in a couple of days. And there you have it, guys, the ICT silver bullet model in front of you, fully explained. Now, if you guys do have any questions, let me know in the comments down below, and I'll be sure to get to them within the next 24 hours or less. I also do want to announce the VIP Top Trading Floor Discord server, where you guys could literally come in and take the exact same trades I take on a regular basis, bagging 57 handles just literally by copying my trade signals. So if you guys are interested, the link will be in the description down below. Again, there's a lot of support, a lot of psychology tips. My whole blueprint is on the Discord server. So if you guys are willing to join, the link will be in the description down below. I love and appreciate each and every one of you guys. Make sure to hit that subscribe button. We are on our way to 1,000 subscribers. Until the next time, peace.